As I said, I did not do a recording because I had even less of a voice earlier this week. So in these slides, it kind of summarizes what to expect in Chapter 12. In Chapter 12, it's all about current liabilities. So you may recall what the definition of a liability is. So you want to keep that in mind as you go through for the quizzes and tests for this course. It's about being an obligation based on past events that the organization then owes. Okay, and the definition is basically the same under IFRS and ASPE. And it's the whole idea is at some point you'll have to settle that obligation with a transfer of an asset, whether it's cash or otherwise. And if you need me to slow down or repeat something, please tell me. When we talk about the types of liabilities, then we have financial liabilities, okay, which are, in the future, we will deliver cash and it's measured at fair value. And those could be in accounts payable. So we ordered something from a vendor for supply purposes, whatever that might be, and we will eventually pay off that invoice. Non-financial, it could be where we promise to deliver a service later on. So a customer provides us in advance for a job that we will do. So it's an unearned revenue on our books, a current liability, and they expect repayment in the form of a service, perhaps. So they've given us that unearned revenue, and in the future, they will get a service. Another example we cover in this course is around warranties. So when we sell a product that comes with a warranty, the customer just expects it to be fixed. They don't want your money, they just want the item to be fixed. So that's considered a non-financial liability. So you want to make sure you understand some of those examples from this chapter. So again, just to highlight, and you would have learned this back in Accounting 1100 or prior, or even prior, is the definition of current versus long-term. This chapter is all about current liabilities. So just remember that there's a 12-month cutoff. So any liability of the organization that you expect to pay off or settle within a year from the date of the statement of financial position or your balance sheet would be considered a current liability. Okay, so typically, your unearned revenues are in there. The first 12 months of any loans that you might have, your trade payables, your accounts payable components would all be in there as well. And so hopefully this is not new information for you. And if it is, please reach out if you need more clarity. We've got some examples on this slide. And again, I apologize. I think Gladys joined after I started struggling with COVID, so my voice is really rough. So I'll be going on mute off and on to cough from time to time. I'll try to catch it. But on this slide here, slide 5, we talk a little about some of the examples that you'll see and you're discussed in Chapter 12. So these are the most common ones that we'll use in this course. So it could be lines of credit, balances for AP, different note payables or loans. Okay, and then again, just a reminder to separate the current portion of long-term debt. Another current liability would be our sales tax payable. So I think you would have learned it before this course, I believe, in Accounting 1011, perhaps. You talked about GST or HST payable. So depending on what province or what product you might sell would determine what rate of tax or sales tax that your organization would be required to collect from customers. So let's just use the example of Ontario, because that's where I think most of us are. Some of you might be abroad right now. But in Ontario, we have an HST. It's a harmonized sales tax. In Ontario, we have a 13% HST. So typically on sale of goods and services, there's 13% owed. There are some exceptions, but unless we tell you otherwise, just expect 13%. One of the most common exceptions, and we would cover this in various courses, is around insurance premiums. So if you have a liability insurance premium or a home and auto policy, typically they only have an 8% TST portion. There's no federal portion. So it's a little bit different here in Ontario for insurance sales taxes. However, related to it is, us as businesses that are providing services and goods, typically when we buy inputs, we have to pay tax on the stuff we buy. So just a reminder that those are considered input tax credits. And the whole idea is what we collect less what we pay, the net amount is what we owe to the Government of Canada through the Canada Revenue Agency. And so hopefully that's more of a recap at this point, because you would have covered it maybe in 1098 as well, using QuickBooks and Sage. If I'm saying something that doesn't align with what you've learned, please tell me. When we move on, another category of current liabilities around employees. Just to recap that very often you'll record salaries and wages payable before you pay them. So you might record it today and pay it on Friday. Say, record it on a Wednesday and pay it Friday, whatever that might be. And then there's all the associated liabilities. We deduct CPP, EI, union dues, whatever that might be. Those are all deductions from an employee that do not belong to us as the employer. We owe it to the government, we owe it to the union, we owe it to the charity, whatever it is collected for. And then other liabilities might be, earned vacation pay by an employee or any profit sharing access, et cetera, that an employee might have access to. And again, I'm hoping you're finding this a recap. Anybody saying this is not recap in this chapter? Just watching to see if anybody's saying that they haven't learned this before. All right, the next, I really apologize for the coughs. The next item is, the next item is your unearned revenue. So I kind of commented on earlier, a customer might give you money in advance of receiving the good or service. So it's, you only recognize it when you earn it. And that's one of what we call our classic adjusting entries. Okay, so there's typically 4 main categories of adjusting entries, and that's one of them. And then something that you may not have touched too much on before are around warranties. So warranty liabilities are typically provided in 2 different ways. So an assurance means that we sold something to a customer and we're providing assurance, or you're providing certainty, or providing our word to say, hey, this item's going to work. So a good example is we buy a vehicle, and a vehicle comes with 3, 4, 5 years of warranty. So the dealer or the manufacturer says for the first 3 to 5 years, we're going to provide you a warranty. Basically, the powertrain and engine, they're covered. But if you their brakes break down, that's on you. It's not a warrantable item. So when they provide that kind of assurance with that sale, it's considered an expense approach, assurance type warranty liability. So in this case, when we sell the item, so when that manufacturer sells the car to the customer, they will record any warranty repair costs as a debit to warranty obligation in that first year of sale. And then at the end of that first year, then they'll adjust their warranty obligation to estimate what they think the potential warranty costs are. So any car manufacturer typically would have what we call actuaries. If you don't know what an actuary is, it's kind of like an accountant, kind of like a statistician. So they look at historical patterns and come up with algorithms to estimate what a good estimate would be. So actuaries are very popular in insurance and financial institutions, because that's typically when you rely on that expertise the most. So you would have some kind of actuarial review to say, hey, based on the last 50 years of experience in manufacturing and selling cars, for every car we sell at $10,000, we have $2,000 worth of warranty expense, whatever that number is. So they can go and make those adjustments accordingly. The secondary approach is, it's a service type. So where a customer buys something from us, but they pay an extra cost for the warranty. So an example might be you go buy an electronic from Best Buy, and they say, hey, do you want to buy insurance for that? You're spending $500. You want to spend $50 more and provide a 3-year protection plan. That's considered a service type or revenue approach. So during the year of sale, they will record any warranty repair cost as a warranty expense. And at the end of the year, they'll look at any of the unearned warranty revenue, so that $50, and say, okay, 1 year's passed, we have 2 more years to go. Maybe I should earn 1/3 of it. Maybe I should not earn anything because most of our warranty repairs are in year 2 and 3. Again, it's kind of actuarial-ish in nature. They can do their best guess. Most organizations on this will just straight line it over the years that warranty is provided. Okay, so any examples we'll give you will typically say, earn 1/3 of it, etc. So it's just 2 different ways to look at it. One where you're providing the warranty service for no additional cost, and one where the customer's paying in advance for that warranty protection. I'm going to pause there for a second. I don't know if you would have covered this in previous courses. Questions on that so far? Hopefully you're still there. All right. So service type. So the service type is where, Best Buy sells you an extra warranty plan. Is that what you mean? Yeah, so the service type is, where you as the customer pay an extra fee for the warranty. So the company that's selling you that extra warranty does not earn that money right away. So Best Buy charges us $50 for an electronics, guarantee for 3 years. They have to put it away as an unearned warranty revenue. Then as each year passes, as that warranty gets older and closer to expiry date, Best Buy earns a portion of that revenue until it's all earned at the end of the warranty period. Does that help, Ying? So there's a little more write-up. If you haven't taken a look at it, I can pull it up shortly. Is in the textbook, there's a little more narrative around it that might help. Explains it from a different way. Otherwise, we can circle back to it later on. Okay, Ying? Okay. Some other liabilities that we sometimes have to disclose and identify are around provisions and contingencies. So sometimes an organization isn't sure if an obligation exists. Okay, I'm trying to think of a good example of this that's not contingent. I can't think of a provision, to be honest. My head's a little foggy. Contingent liability has to do more with, depending on the outcome of a court case, or depending on the type of customers you have and what they may or may not come back to you with. There might be a possible liability. And in most of those cases, you just disclose it on your financial statements. Sometimes you have to quantify it. We'll cover more of those details a little later. But just to be aware that there are such things as provisions and contingencies, and I'll post a little more detail on that. It'll be easier. I just have to remind myself about provisions. To be honest, I can't remember because I don't run across them often in my day-to-day job. But contingent liabilities are typically around HR labor law claims or vendor claims. So say you had a vendor contract that you believe was settled, but the vendor is disputing something. You believe, everything's okay, but there's a possibility that, they might be awarded a $100,000 settlement by the courts. So you don't record the liability, but you might disclose the fact that you have exposure to that contingent liability. It's contingent upon, a court outcome, a lawsuit outcome, et cetera. Okay, so just be aware of that, and we'll come back to that one as well. And then one of the last types of current liabilities we cover in this course, or in this chapter, is about decommissioning. So sometimes you build a factory or lease land or lease factory space, whatever that might be, for a period of time. And the person you borrow that space from, or the purpose that you borrow that land from, perhaps, you have to return it to a specific state at the end of the time. So that's called a decommissioned cost. So say we went to the City of London and said, hey, can we get the soccer fields, across from John Paul II? I want to build a a factory there for the next 10 years to do something. But I promise to return it back to not just soccer fields, but I'm going to put up, some fancy buildings for vendor stands, etc. Okay, so that, and London agrees. So the cost to put it back to green space, back to soccer fields, and build those commitments back up, say put those new buildings up, say it's going to be $3 million, those are considered decommissioning costs. So under the rules of accounting is you actually start accounting for that from the day that you take over the land. And there's example 12.9, I could pop up later on too, that walks through an example of that. So you have to present value the whole thing. Well, again, we'll do an example of how to go through this process. So in that situation, you'll have the future asset, okay, the fact that you'll have, something that you'll create in the future, and you have a liability, the future asset, the liability associated with setting up that or decommissioning that site, and then you'll have the depreciation and interest over the next number of years until you reach that point in time where you need to decommission the site. Again, hopefully it'll make more sense in the actual application, which we will pull up soon. That's the key materials. What I'd like to do is pause here first before I pull up some questions for you and I, just to, test our understanding of some of the key concepts. Questions so far? I'm hoping everybody had a chance to look through chapter 12. It'll really help when we come together if you do. Just pausing for a moment. Where to put that file? Here it is. All right, so what I'd like to do then is go back to here, is if you go under content chapter 12, if you have access to your computer, if you can go to the May 11th class working file, it's a link to a Google Doc, okay? So in there, if I just go back to it, you will open a file that looks like this. So this way we can kind of work on it live together. Okay, and these are just some generalized questions based on some of the key activities. Okay, so I'll give you a minute in case you want to pop in there. Again, just to show you where that is. Oops, not my Union Gas bill that I didn't close yet. So it's under chapter 12, current liabilities. There's a file called May 11th class working file for those that want to jump into it live. See if I can zoom in here. I'm not a big fan of Google Docs, but we'll see whether this works. It says view only, does it? Okay, let me see. I can't remember the details. I can't remember how to change view versus edit. Anybody know off the top of your head? I don't use Google Docs often enough. Can't access this. I know there's a setting on here. Editor. There we go. Maybe that'll do it. Now it should work. Okay, I see somebody else in there. Perfect. Perfect. So what I'd like to do, I'll give people another minute in case somebody else wants to join. So these are kind of mini exercises. So the exercises in the textbook are a little more comprehensive. These ones that we'll do together right now are kind of just miniature. Sorry. So this first example then is I want somebody to, think about this situation. We have on November 1st, 2021, Elmer Limited signs a 3-month, 8%, $100,000 note. What would be our accrued interest? Anybody want to determine what that interest might be? How would we calculate it? You can either, type something into the box, use a formula if possible, not a calculator. Okay. don't see anybody actively selecting the cell, or do you want me to pick somebody to try it? Anybody want to take a stab? Or if you don't want to type in the document, you can always type it in the chat box as well, what you think the formula is. Oh, I lost some folks. That's okay. So not hearing anything, what I'll do is in here. Oh, perfect, perfect. So somebody just typed, thank you. So we've got $100,000, so that is considered our principal, correct? Times the 8%, which is our rate. And then we have times 1 out of 12. Why is it 1 out of 12? You can either type in here, you can unmute and say it. It's 1 month. Watch your dates. What are your dates again? We reread it. It says November 1st to December 31st. Yes, that's right. So it should be 2 months instead. So if I go put this in here, oops, oh, it didn't copy my formula. That's weird. I had a formula saved here. So we'll type the formula right in there and it'll calculate the 1,333 and 33 cents. So yes, it is 2 months, not 1 month. So really pay attention to those dates. It catches people often. So don't feel bad if you missed that. Okay, but it is the 100,000, 8%, 2 months out of 12. Okay, great. Let's move on to number 2 then. Number 2 says on September 14th, we sold an item and the sale occurred in Ontario. How much HST should be charged? So thinking about normal HST, what would that be? So we got a couple of folks saying 13, great. So how would we calculate that again? Yeah, it looks like somebody typed it in there, great. I'll pop it in there then. And technically, and this is a pet peeve of mine, I always use the round button or the round function. So you should have taken an Excel course already, 1097. So even in this first one, always round. So I'm using somebody else's notes and they didn't have to round it. Huge pet peeve. Because it will come to bite you in the butt later on in life at some point. Okay. Any questions on that? I think that one's pretty straightforward. So unfortunately, we go buy $365 worth of something, we're paying more for the HST. Good. For question number 2, then, what account should be credited for the HST? So remember, we provided a sale. I've got one person in there already. Great. HST payable is correct. And what type of account or category of account is the HST payable? I'm thinking about the 5 categories on our balance sheet: assets, liabilities, revenue, expenses, and equity. Sorry, I got that mixed up. But so which account or account category is that? No takers yet. It is a liability. That's what this whole chapter is about. Okay. And what do we have to do with that HST eventually? Where does it go? Use your unmute, feel free. Remember, we have to send it to the government. Okay. So I'm not trying to trick you. I'm just trying to have you make sure you understand the start to finish. So we collect it, we apply any input tax credits that we paid on our supplies, and then that goes to. All right, let's carry on then. What are some of the required payroll deductions? I see we've got EI in there. CP, and we'll call that CPP, Canada Pension Plan. Okay, and what's the third required payroll deduction? Income tax is correct. Good. When does CPP apply? Do you remember those rules? You might not have learned it. You might have already. So just so CPP applies to anybody that's over 18 years of age. If you're under 18, you do not have to pay CPP or take those deductions off. Typically, you pay CPP until you're done working, or if you're over 70, you have to stop. Or if you start collecting CPP, say at 55 or 60, you can elect it to stop. Okay. Employment insurance, EI, applies to everyone. So if you work, you are required to pay EI. And income tax obviously applies to everybody, but there are exemptions. So if you're only going to make $15,000 in a year, you're below that bottom threshold. So you would not pay income tax. Otherwise, it's based on your tier of expected income in the year. RPP, you're talking about the registered pension plan, I'm assuming. So registered pension plan is not a required payroll deduction by the government. It may be required by an employer, okay, and they can't require it without the employee's consent. Okay, so typically what happens for RPPs is when you're given a job offer from an employer and there's a pension plan included, it's in your letter of offer, and it'll say, you know, you will participate and the company will match, whatever that is. And when you sign that letter, you're acknowledging the fact that you agree that they will take it off. Some organizations might say they have a voluntary pension plan, and a voluntary RPP or RSP plan. In that case, it is a voluntary, and you can opt in and opt out typically. So it depends on the employer, but it's not required by the government. Does that help? Oh my gosh. Question 3, got a question in the chat. Question 3, the debit is what? The credit is what? So in this case, okay, I just want to read it. Question 3, so that's related to number 2. So we sold an item for $365, so we'll have a credit to revenue for $365.76. We'll have a credit to the HST payable for $47.55. And then the debit would be the combination of the two. So what would that be? $365.76 plus this. So the $413.31 debit will either be cash or AR. So it depends on whether the customer paid us right away or not. I'm just answering a direct message in the chat. Okay, perfect. So that would be a debit to cash or AR. All right, so yes, HST payable. I'm just gonna clean this up. So these are correct. I took over the boxes, but that's okay. All right, let's move on to number 5. So number 5, we have an example here. We have 10 employees that work for a company, and vacation pay accrued is based on the pay for the month. August gross payroll was $23,560. Vacation accruals 4%. What journal entry should be made? I'm going to pause for a second. Who wants to take a stab on what the journal entry would be for number 5? Anybody want to take a stab? First of all, how would you calculate the amount? Somebody typed in 23,560 times 4%. Yes, that's the right formula. It looks like somebody missed a decimal. 942.4, yes. So just make sure you pay. So just check the formula in cell C21, whoever's working on that. I'm guessing you did times 0.4 instead of 0.04, so just be very careful on that. 2, 3. Sorry, I'm just reading a message in the chat. You wouldn't actually take the gross payroll divided by the number of people unless you were tracking the vacation pay expense by person and it was all the same. Otherwise, that dividing by 10 people doesn't add any value at this point. Okay. So you would just take the total gross pay times the rate of vacation accrual, 4%. So it should be $9.4240. So if we look at this, oh yeah, we have a times 10. No, it's not times 10. That's why. Okay, so it's not times 10 people. The total gross pay for all 10 was $23,560. So I just made that edit there. Okay. And then we have salaries and wages expense. It could be, or you could have a vacation pay expense account. Okay. And then vacation pay payable or liability. Yep. Okay, and then I'll just, okay. Actually, is there another? Any other questions on number 5 so far? All right, let's move on to number 6 then. Number 6, we have the company with the following deductions. So we're told CPP is 100, EI is 200, income tax 1,000. What's the company's portion of CPP and EI? Okay, so how would you calculate the employer matching portions? Again, I'm hoping this is all recap, accounting 1100 or 1011, or it's a payroll course too, some of you might have taken. So how do you calculate, first of all, CPP? I'm going to give you a minute to think about that. So CPP, do you remember the rules? I can remind you, CPP is 100% correct. So somebody type that in the chat. Great. So CPP is 100% match. So in this case, it would be the $100. Okay. And what about EI? Assuming no reduced EI matching. What's the EI matching? And yes, so somebody type that. Perfect. I'll just fix that in a little bit. Appendix Zero. So how would you do EI? I like our names in here: anonymous kangaroo, anonymous chameleon, anonymous otter, anonymous dolphin. Who else do we have in here? Anonymous. What's a quagga? Anybody know what a quagga is? Quagga. I have no idea what that is. Looks almost like a zebra on the picture. EI. Not quite 1.66. Not sure where that number comes from, actually, unfortunately. So the matching rate is 1.4 times. Okay. So 1.4, somebody did fix it, great. So 1.4 times 200. I'd be curious, 1.62, that's probably your current deduction rate per 100, I think it was. I think that's the current EI rate. So 1.62 is the current EI rate, which is what the employee is required to make, and then employer has to pay 1.4 times that. So the employer portion is actually like 2268 approximately. Okay, Okay, so once you've calculated this amount, you don't need the rate per 100. You just take the amount that you deducted from the employees times 1.4. That's your employer match. You don't have to go through and redo the calculation. Okay. Any questions on EI? What about income taxes? Any matching amounts? Say, are there any matching amounts on income taxes? No, there are not. Good. I just wanted to see if anybody was paying attention. Thank you. All right. So I'm sucking on a candy trying to see if that'll help. Number 7. So number 7, we have a company received a $35,000 amount in advance of performing a service, and at December 30th, 20% of the work has been completed. What's the adjusting journal entry at December 30th? So remember these adjusting entries. Chapter 5 and counting 1100. Somebody's got the right amounts. Great. So it's 35,000 times 20%. Great. Debit to unearned revenue. Perfect. And a credit to, drum roll. Just gotta wait for it to enter and refresh. Now we have anonymous chipmunk. That's funny. And to revenue, yes. So somebody typed in the chat, revenue. I don't know why that didn't pop up, but yes, you would put revenue in here. So it could be service revenue in this case. I'm guessing yes, it's in advance performing a service. So you'd probably want to put service revenue. Okay, good. And 2 approaches to recording warranties. Somebody's jumping ahead. Great, thank you. We've got revenue or expense approach. So we just talked about in the slides. So under warranty, we've got the expense approach, which is based on where you as the provider are providing the warranty for no additional costs, part of the original sale. And then the revenue approach, meaning that the customer paid in advance for warranty coverage. Those are the short versions. Okay. If you want an example of that, 12-6 or 12-10 would be a couple of questions to look at. Oh, actually, I got those backwards. 12-6, 12-10. Okay. You doing okay so far? And somebody answered number 9 already. If we receive a customer deposit, ask their liability. What liability is it? It is a liability. The warranty does become an expense, yes. So I'm answering the chat again. Actually, I'll paste this in under the, I'll paste my notes in here. So here's the short form. So no, don't get confused by the method. So there's an expense method of recording warranty expense, and there's a revenue method of recording warranty expense. In either case, warranty is an expensible item. It's a matter whether it goes through an obligation and then adjusted at year ends, or whether it comes in as an expense and you earn warranty revenue associated. Okay. So under the expense methodology, in the first year, as you incur warranty expenses in the first year, you will debit the warranty obligation liability. Okay, it doesn't go to warranty expense right away. At the end of the year, you would then look at your warranty obligation. What should my balance be? And it should be a credit. So you'll need to get that from a debit balance to 0 and possibly to a credit based on what your predicted warranty costs are. So you're basically creating an allowance for warranty obligation. At that point is when you would debit your warranty expense and credit your obligation. Under the revenue side, that first year of activities, we would debit warranty expense for any warranty activities. And then at the end of the year, we look at our unearned warranty revenue that our customers gave us in advance and earn a portion of it. So as my example, Best Buy, we paid them $50 for a 3-year warranty coverage. 1 year passed. I did go in once and they fixed something for $5. So they would have a $5 warranty expense already on their books. However, that their unearned warranty revenue, that maybe they'll earn 1/3 of the 50 as revenue. So under the revenue piece, there's a revenue and expense piece. Under the expense piece, it's only an expense with no liability. Does that make sense? I hope. That might help. Under the revenue version, you'll have revenue and expense. Their expenses, you only have expenses. Does that help? Or are you going to send me a confused face? That's okay if so. Yes, warranty obligation is a liability. Okay. Warranty obligation is a liability, yes. So number 10, I'm gonna keep going. Oh, so for expense, liability is reduced. No. So for expense, liability is reduced. In the expense methodology, yes. Because you have an estimate on your books of what you think you might incur for warranty. When you incur warranty costs, it reduces that warranty liability. And at the end of the year to say, do I still have enough liability left? And if not, then you increase the liability and increase your expense. So yes, expenses, expense methodology for recording warranties starts with the debit to warranty obligation to reduce the obligation. You only have warranty expense when you right size your warranty liability. Does that help? Okay, perfect. All right, and then number 10, we've got two, sorry. Of course, I'm talking too much, so it's really flaring up. So a couple of aspects of decommissioning costs. Yes, we talked about depreciation and interest. What are the other two? Just because there were 4 components. Kind of hinted at that. Go back to the slide. So there's the asset and the liability associated. So you set up an asset liability on day 1 based on the discounted value of what your decommissioning costs are. Then you depreciate that asset over time and you add interest expense, which grows the liability to the value that you estimate that future liability cost to be. Perfect. So that is correct. So 2 of those count, but those are all 4. So here we go. I'm just going to paste in some notes. And then again, /9 off. I'll pull that one up in a moment. We'll do together. Sorry, someone typed 9 in the chat. What did that mean? It's a private message, but forgot it or forget it or forgot it. All right, any questions on these kind of short ones? receive it means liability. Question 9. Thanks, Malik. So to receive it, yes. So number 9, this is just like the example, the first half of number 7. So a customer gives us $10,000 up front for a future service or a future good. It's a liability on our books. So we have the cash in hand, but it's a liability back to the customer until we deliver that good or service. So it's unearned revenue in most cases. Okay, great. Any questions on these 10 little simple ones? I received 1 no so far. No questions. Okay. What I'd like to do is pull up question 12.9 in the text. Unless everybody's gone through it, then we can do a different one. But I thought I'd pull that up just to kind of walk you through that warranty one, or sorry, decommissioning one. So I think that's probably the most difficult one of this chapter for some people, maybe not for others. So let's look at 12-9, and you do have the answers and solutions in here. So hopefully that helps. But I just wanted to walk through it. So 12-9 in the So 12-9 is this manufacturer who creates bypass machines used during open heart surgery. The company expects to continue manufacturing the machine for another 10 years, and then it'll become obsolete. The company has agreed to vacate its factory in 10 years' time. The local government granted the land for the facility on the condition that it'll be returned to the original state when vacated. This is like the example I gave earlier. And in this case, the company has also agreed to build a public park on the site once the remediation is complete. So the companies estimate the total cost of site remediation, tearing down the factory, ripping up the parking lots, whatever they have in there, and putting green space back in. They're estimating $3 million. And the park that they've agreed to construct is another $500,000. So they have a $3.5 million cost in the future to incur. We're told the discount rate is 11%. And then we're asked to create the original journal entry and then the entries for the first 2 years. So anybody want to take a stab on how would we calculate the values for step A? And maybe you've already looked at the solution, that's okay. But anyone want to take a stab, think based on what we've talked about? We talked about present values. So in this case, our total cost, $3.5 million. Somebody typing in here? No. Just wanted to make sure nobody was typing here and I was missing it. So we have our $3.5 million. So that's the future cost. So we're asked to discount it 10 years at an 11% discount rate. So what I'm going to do is I'm going to actually go down to this calculation. So whether you have a scientific calculator or Excel, whatever that might be, if you present value $3.5 million, 10 years at an interest rate of 11%, you'll have a present value of $1.2 million. That becomes your debit to the original asset, so debit to the factory asset, and a credit to the obligation for site restoration. So basically you're inflating your assets and inflating your liabilities based on that future decommissioning cost at present value dollars. Okay, so some people might say, that doesn't make sense. Why am I adding an asset, adding a liability? Well, it's because you're recognizing today what the future cost would be of that liability and the fact that you're using that space for 10 years. So you need to depreciate the fact that you're added value to your factory for $1.2 million because you have access to that land for 10 years from the city. Yes, you can absolutely use the financial calculator. Yep, same result, same result. Somebody asked if they can use an Excel financial calculator. Of course. At this point, I'm not too worried about the math. I want you to understand the concepts and the journal entries. That's what's important in this course. So yes, you can use a financial calculator or Excel. So here we are, we have our present value. We'll debit the factory, credit our obligation. And then remember, yeah, let me pull, sorry. Yeah, 2 seconds, let me open a file. Bear with me, I just need to open a file. I could just start it from scratch, doesn't matter. Let's go like this. So we said we've got 3.5 million. I was going to reuse something I had, but, and we've got a 11% discount rate and 10 years. Yes, you can. C equals present value, PV. I pull this up. We've got our rate at 11%, our number of periods, 10 years. Our future value is the 3.5 million. And therefore, there we go. So don't forget to put the negative value. Hopefully you remember that from accounting 1097. So just to pop that up again. There we go. Does that help? So it's the rate of 11%, 10 years, and negative future value. And that'll calculate our present value at 1.232 million. Perfect. Okay, let's go back to here. So we've debited our factory asset and credited our obligations, our liability. Then what happens is every year we'll have adjustments. So we need to depreciate the factory down to 0 by the time we're completed with it. And we need to grow the obligation up to 3.5 million. And how we grow that is based on the discount rate of the 11%. So the first year, depreciation expense, let's just assume we're straight lining the factory over 10 years. You might have a policy that says, you're going to, take 20% year 1, blah, blah, blah. But for all purposes, we're just going to straight line it. So the 1,232 divided by 10 years is a debit to depreciation expense and a credit to accumulated. So you'll see that that asset shrinks by 10% per year. On the liability side, we need to grow the obligation, and we need to grow the obligation by 11% per year. So you take the original obligation amount of 1.232 million times the 11%. So we need to credit the obligation to increase the value of that liability for 135,591. And then we'll debit the interest expense for 135,500. So it becomes an expense to the business over the life of the asset and the growing liability. I can show you this in Excel in a moment. We can quickly do a schedule together. And then year 2, obviously depreciation straight line over 10 years. So it's the same amount. And on the interest expense side, we now have the obligation was 1.2 plus the amount that we added to it last year times the 11%. So your interest expense will continue to get more and more and more each year based on the growth of the liability. So let's go back over here. I'm trying to think the easiest way. I'm usually pretty good at Excel, but my head's not super clear. So let's go year 1. Okay. We'll go down to year 10. So we'll go equals this times this. So I'm not going to bother rounding right now. So new liability balance at the end of year 1. Okay. So you can see over time. Okay. So our interest per year, 135,981. It's growing each year. And our new liability balance started at 1.2 million, grew by 135, and you can see that it adds up to the 3.5 million by year 10. I guess that's another way to see that our math worked on the discount. Does anybody need to see those calculations a little closer? So the year 2 expense, so you need to take the closing liability amount from the year before, which is the original cost, plus the interest from the year before. So it's the 1.368 times the 11% interest. You see that there? So if I go back to the text for a moment, you can see it here. It's the 1.232 plus the amount that we added to the liability last year, all times the 11%. Okay, and that's why actually, if you're using Excel, I'd strongly recommend you use Excel for some of these exercises, because you can do things like this and just prove that it works. You calculate the interest for all 10 years and the fact that the liability will be 3.5 million at the end. Okay. Any questions on that? All right, so what I'd like to do is open it up to you. Did you have a chance to look at some of the chapter 12? Do you have specific problems you want to review? Before I take those, I'll just remind folks that do want to drop off and do some work. Don't forget the quiz that's coming up. It's due. Some folks have already done it, which is great. It's 4 more days from now, May 15th, chapter 12. And if you have not completed the academic integrity quiz yet, please do so. We've got about 2/3 of the class that have done it. But don't forget to don't miss those deadlines, please. But please make sure you take care of that. So yeah, now I'd like to open it to you. If you have specific examples or exercises you want me to review, we can. And then for future weeks, my plan is to record the walkthrough on the PowerPoint slides Sunday or Monday, post it by Monday mid-morning sometime. And then when we get together on Wednesdays, we'll do kind of a Google Doc together, answer some questions on the topic, and then you can bring questions forward that you want to walk through and hear examples of. If you miss our time together or miss the opportunity to ask, you can always email if you want some extra support, direction, and I'll support you that way. If you want to just drop off and do your own thing, feel free. If you want to hang out here and ask some questions or whatever that might be, I'm here as well. Trying to find a balance of both. And if you drop, take care. We'll see you soon. I hope so too. Thanks. I hope I feel better soon. It's going. This is day 5 now, so I'm hoping to turn. Yeah, I'm sorry for the coughs. I'm sorry, but you're very welcome. How long does it take COVID? It depends. I've heard people 3 days. I've heard people 6 weeks. One person I know was severely ill for 6 weeks. So thanks, Elizabeth. Yeah. Thanks, Gladys. I'm glad we're not in person. Otherwise, this would really suck. 10 days. Yeah. I heard the cough lasts after other symptoms disappear, but any questions, Ying or Elizabeth? I can stay on. I'm not rushing you. I'm just asking. Ying, yes. Luckily, we have room in the house, my office, and I've got a separate office already, and we've got a spare bedroom. So my wife's in the spare bedroom, and the kids have their own rooms. So yeah, thanks, Ying. Thank you.